Okay, Saturday, October 22nd, 2016. I'm going to run through commodities right now. I'm going to use monkey bars off of Thinkorswim platform. For those of you that use it, let's take a quick look here. Let me start off by actually showing you the dollar index. Okay, so here's a weekly on the dollar index. Okay, basically the dollar has been in a sideways channel here. Sideways channels, you can use it as a measuring pattern. Okay, similar to like flags and that, where you measure the amount of the pattern. So in this case, I'll just kind of use a rough one here of like 92, 93, and then back up to 100, which is 7. So on the upper end, if the dollar should break out here, the targets would be 107 to 108. Now, currently, the amount of longs in the US dollar, okay, let's take a look and see if this is working. Yeah, okay. The amount of longs in here is not as high as it was back in fall of 2015. So there is still more room to run on the US dollar on longs. This is the Commitment of Traders report. This one's from Scotiabank. Comes out on Friday. Commitment of Traders basically shows the poker hands of the players. It's basically distributed every Friday afternoon. The data is collected up till Tuesday. Sometimes there's holidays and such, and so it may be released on another day, plus or minus. Going back to the dollar. Oops, where's my dollar? Come on here. Okay, dollar index. Okay, so you go back and you take a look at this would be the spike of the amount of volume that we saw in the previous chart graph of the amount of longs in there. So there was a peak back here in October, December, November period, actually November, which is timely because we're going to roll into November here, of longs. Okay, and currently the longs in the US dollar futures is what's that, 15.20, and it was up to about 45. So we'll say a third, plus or minus a third of the amount of longs are in there compared to previously at a previous high. Okay, so in a sense, what I'm saying is that you can still have, you can double the amount of players in here. The dollar has moved up above 50% of this retracement area. So I would assume here going forward with a stronger dollar that this will affect commodity pricing, because the dollar clears 100, then all of a sudden commodities will have to adjust, and they typically adjust lower. We've had periods of a stronger dollar under Reagan. Got up to 164, and that was because of high interest rates. If interest rates go higher, money begins to flow into the interest rate to collect the carry cost, okay, for on the carry trade. Okay, so you'll have money start moving into dollar-denominated pairs of currencies. So like that's why I like the dollar yen. The dollar CAD is a little less of an opportunity because of where it's at in relationship also to oil. Then you have US dollar Swiss franc, which is, it still has a ways to move. I just like the yen because the yen was used in the carry trade leading up to 2007 also. The yen was also had a big reversal in the mid-1990s. But everything cycles. Usually the currencies trend for a long time, like with interest rates, 4 to 8 years. Okay, so in a sense here, basically how I'm looking at this is that the dollar in this long cycle should peak I'm going to guess like a recession of 2020. I'm just using historical on that in relationship to the real estate cycle, because real estate is such a huge driver of economic growth in the United States. One of the few places of building wealth in real estate currently. We're in the last half of the real estate cycle. It should peak in 2024. It's an 18.3-year cycle. I have data going back to 1790. I also have data going back in Amsterdam, Holland, the Netherlands from 1400s. And that gives me a inflation of about 3%. So that's why they always try to target 3%. All right, so here's the dollar. Okay, dollar's had a nice upswing. There has been a lot of people moving into the dollar, but what I thought was interesting is that on the opposite end of the dollar getting stronger, typically it's the euro that's the weakest of the bunch. Take a look here at the euro. Okay, so here we have the euro, and it's about halfway to the amount of shorts in there. My target from, I think when we were talking before, we'll say the 112 area was into 108. We're into 108 now. So I would expect some sort of short covering to enter the euro. So I mentioned on Friday about tightening up the stops, depending upon where you're at. Some of you might be short the euro from above. I don't expect the euro to go back into the 111, 112 area, but whatever short covering should be short, sharp, and quick. I look at the euro to continue to go lower, just on the back of the US dollar strength. In theory, in macroeconomics, as interest rates go higher, banks are more willing to lend, putting more money in the economy, hence higher interest rates, which they'll put more money in the economy, and it feeds on itself. So in that sense, higher interest rates, higher dollar, that'll drive imports. So in theory, we'll have a lot more imports coming in versus exports will be difficult. That's why the commodities will have to adjust. Okay, and so on the dollar, I'd been talking before about I think 101, 103 area. This is a weekly, so here are the pivots. Here's the pivot, which is around 97. I'm just looking at this as that the dollar is basically, I don't think this is distribution. If the dollar should roll lower, we're going to have a lot more issues out there than just imports and exports here. If the dollar because a lot of things will have to adjust because of they're priced in dollars. Okay. Take this, for example, interest rates go higher and you're a foreign owner of debt. Yes, you may get a currency appreciation when you repatriate the money, but you also have capital loss on that debt as interest rates go higher against what you own. The underlying price drops. Okay, so take, for example, FTSE and the pound. Even though the FTSE has made a 16-month high, I believe it's up there, the currency lost more. So even though things were, they swung your way, the repatriation of the dollar just didn't balance out. So it's kind of like going to the track and getting in an exacta box and winning but losing at the same time because it didn't cover the wager. All right, so the dollar here, I expect it to continue higher, mostly in next year. Seasonally, interest rates have a tendency of coming down because the Federal Reserve floods the marketplace for the holiday shopping season. So there's more dollars about. Like I said, any type of pullback, bounce in the euro, it should be quick and would bounce higher. But it's just that's going to be just an oversold short covering rally, profit taking, whatever you want to call it. But I do expect the dollar to break out probably into 2017 and continue higher along with higher interest rates. What we need to see in the economy right now, we rolled out of the commodity cycle. The secular bull market in commodities is basically over. I look at whatever happened from January forward is just a bounce in the larger bear trend, and then that should continue. What I've noticed, though, in equities is that there's a lot more, even of recent, there's just a lot more people waiting to do something. I'm anticipatory, so I try to look and see what's going to happen tomorrow is how I look at it. I don't chase after anything. I basically look for opportunities. So we'll say natural gas. Natural gas, all of a sudden it hit a 17-year low. That perks up my ears. Why? Because I know my risk is with commodities, they can only go to zero. So for me, when I hear a 17-year low in natural gas, I'm all over it. Then you have like the British pound, same thing. They start talking multiple decades. Yes, the British pound can go lower, but we've seen what happened in like 1985 with when they left the ERM, basically kind of the same thing. The pound traded higher. I expect the pound to quietly move higher. In the background, people will be chasing after something else. In regards to equities, in the background, okay, pre-Brexit, I talked about that you guys were on your own, that I thought that the swing higher from Brexit, basically, let's take a look here, see if this comes up. Okay, so here we have Brexit. Okay, so here we have Brexit and the swing higher. Okay, now I'm using psychology on this. You have the buy the dip people. Okay, so you bought the dip, but when this went higher and I started going through all my charts, I noticed that more and more charts I use IBM, for example, that peaked in 2013. A lot of these had peaked prior. So this swing higher, the people that were excited were basically, I will say, new people to the marketplace that they like the long side of equities. I looked at it as, all these charts that kept continuing to go through over and over and over, U.S. and foreign, they had rolled over. Yes, there are opportunities in, say, like banks and stuff in Europe and America, where the sector was lagging, and that's just because their interest rates, their margins, okay, they're making it up in fees. That's basically how they're doing it. But as that wideness of their interest rates, what they borrow and what they lend at, that's basically their profit. And outside of that too, different branches, they can get into other things, underwriting, that kind of deal. They're not supposed to, of course. We have fewer and fewer banks, money center banks. So the next time around, it's not going to be so pretty again. So, but in the short run, okay, so you had the Brexit, you had the swing higher, okay, and basically this is the pivot, R1 and R2. We got up to R1 and basically said, you're on your own. I just thought that all these charts that go through, became obvious. You run through the 30 Dow, you run through OEX or SPX, or the NASDAQ was different, of course. The NASDAQ and the Russell did peak in 2015, okay. Those were the smaller cap stocks. So when you rotate out of a secular bull market in commodities, you have to put your money somewhere. It's the same type deal. We'll go back in 1987. There was the peak of the real estate market. Came crashing down, and then we got into technology. The NASDAQ was the biggest, is where all the money flew into. So I looked at basically the same principle. Money came out of commodities, has to go somewhere, go into technology. The NASDAQ overhead, over-the-counter type stocks, low price growth, versus the old New York Stock Exchange, which also peaked in 2015. New York Stock Exchange smokestack conglomerates, because one, they have to move a lot of product. Okay, yes, 95% of the world's overseas. So if the United States falters, they still have other places like China, India, Asia, Europe, things of that nature to sell their goods, wares, what have you, services. But they also will have issues with the dollar for repatriating. Eventually, of course, somehow, somewhere, some way, it might be in 2020 or after, with that, after that election, that money that's overseas, one way or another, they'll get it repatriated somehow. Tax code. There'll be something that will say, hey, fine, we'll bend the tax code for you, repatriate the money if you hire people, what have you. The old follow the money. So when we had the Brexit and we had the swing higher, and I noticed that a lot of issues had peaked, rolled over, I didn't think there was enough of underlying internals in that could support it. Okay, we had a lot of sideways going in on this here. I've posted charts of the little pink dots, which is the summation index, which is the number of issues that are participating. It's kind of like a net cumulative of up issues and down issues. And I looked at it, let's take a look here. All right, this one's hiding out in my day trader blog. All right, the little pink dots. Okay, here's your New York Stock Exchange. Okay, so those are your smokestacks, your industrials, that kind of thing. Your larger cap items, issues. It peaked here in 2015, which also you had European indexes do the same thing. Recently, though, some of the European indexes have eclipsed their 2015 high, but I'll view that as a double top. Okay, so you have your issues. Okay, the number of issues participating, and then on this last leg up, you can see here on the NASDAQ, which was our leader, the NASDAQ broke out new highs. It only took 15, 16 years, which was, I think that was the same as when 15 years was a number that showed up once before. I believe that was when we finally cleared 1982 high. I believe the stock market, I think, peaked in 67. Yeah, I think so. It hit 1,000 for the first time, and then it gave it a couple more goes, and then by 1974 December, it lost roughly half. Okay, and that was our oil shocks. But basically, this is the pink dots are your summation index. This is the number of issues. So if you're going to move to new highs in that, you're going to want to have all the issues come forward. So you have some underlying strength. Okay, so in my eyes, what you have, first off, is you have the peak in 2015, correction, okay, and then we have our bounce, and basically I'm just viewing this as a bear market rally, okay, for right now, just due to the fact of, one, the bear market or the bull market's been going on for a while, which also is similar to coming out of the Great Depression. It took 25 years for the first recession after the Great Depression, but we also had to have World War II in the middle of it. And then we had our growth with the soldiers coming home, the baby boom, and building homes, and yada, yada, yada. Okay, so you have your issues. Okay, so then when tried for a new high, okay, didn't work, and also the underlying issues are beginning to falter here. There's less issues. Even if you come in with a one lot and push your stock up a quarter or whatever, it would at least be beneficial. Okay, it's not helping. This is going back even further. Okay, so the two theories here is if the bulls can try and muster something here. Okay, now remember that there's a lot of people on the sidelines. The sideways over the summer and into the fall is the whipsaw is beginning to affect people. I think it was Thursday we were all over the board. Hit what was it? I think we hit 2020 and went back up to 2040. I'd sent out a thing talking about judging by the money flow. The bulls could walk this thing up to 2080, and it basically stalled once again at 2040. So our range is narrowing, but the two schools of thought are if the bulls can muster something, because of the number of issues that aren't participating, it would have to be a broad-based rally. I talked about how narrow it's becoming. Here is the NASDAQ composite. So this has all the issues on the NASDAQ. And it had moved into a new high, but on fewer issues. And even when they're trying to muster something here, it's not working. The number of issues contributing is faltering. So I look at this here as weakness, underlying weakness, but the two theories are, like I said, is if the bulls want to muster something out of here, it's going to need to have a broad-based rally. Basically, you're going to have to look at that as economic. I don't see that. We have two issues. One, like I said, new home sales is basically what we're shooting for to help the economy. Just so many jobs in building a home, not just the construction workers, but you have everything, the door hinges and the handles and the lumber and the wiring, and then you have your services. You know, do they need internet? Do they need, TVs and carpeting and paint and on, insurance, on and on and on and on. But what we have is, because of the baby boomers, we're going to have a supply of housing out there. As the baby boomers downsize, I live in a town that in 2005, there were 4 and 6 car garages and a thing for a Monarch bus. Okay, that to me is a little audacious in regards to, it peaked for the baby boomers for everything there. They took and they bought jet skis and off-road vehicles and that Monarch bus and that on and on and on. I mean, you wouldn't. Right? You wouldn't build your dream home in your 50s and 60s with a 4 and 6 car garage and thing with a bus. Well, in my eyes, that was kind of the peak of the baby boomers too. Baby boomers, I believe, are the first generation to actually leave the nest. And most of the time, just like with the Waltons old TV program, everybody multiple generations lived together. And we're beginning to see that now. We talk about boomerang babies, they come back but that's it. It's not a sign of failure. It's just what it is. If you have earnings not keeping up with the cost of living on your own, what have you, it's just not going to work. And we have the wide dichotomy of CEO pay, which is just egregious, versus employees. And I talk about it all the time. Look, if you pay your employees more, they're going to buy more widgets, right? And all these guys, their pay is beginning to be tied into their share price, and of course they run out, offer debt, buy back stock. I mean, down the road here, of course, after they're long gone and have their parachutes, the corporations are going to have to deal with servicing that amount of debt. So we may end up with a longer period here of sideways, having to digest this. We've had a pretty good run on equities. It's mostly due to the stock buyback. The number of companies out there, I think, are a little more than public company. I think are more than 4,000. The statistic I saw was like it's gone from 12,000 in the 80s to 4,000 today. So we have fewer and fewer out there, and less competition. Yada yada yada. You don't have to work much when you're basically in an oligopoly. What was the one? Oh, like modems, routers. 10 years ago, they were $60. If you had cable TV, you'd get a box or something. They're $60. Now they're $100. Same thing with phone service. Your phone might have been $25 in the 80s, and now, a cell phone, they'll probably, they'll want $120 or whatever for all the gizmos. But down the road, we're definitely going to have problems with dealing with servicing the debt. But okay, so for right now, like I said, I don't see this as a bull move. I'm still going to give the bulls the benefits of doubt because they've had the momentum going forth for a while. But with the drop in the issues that are participating, even on the NASDAQ side, the NASDAQ was our leader. You know, you can buy your Apples, you can buy your Amazons, you can buy all of those, but it becomes narrower and narrower and narrower. And we need a broad-based rally here for this to continue. For on the NASDAQ, I'll treat this for right now as, we'll just say that this is a retest. Okay, this was a little bit deeper of a retest than I'd like to see here. Retest, but basically, in theory, okay, getting back to here, if this is the top in 2015 in the New York Stock Exchange, it bottoms, moves higher. If it loses 10.5, we'll say 10.4, 10.5. If it loses that, okay, it'll continue lower. Now I have to look at the big picture here. All right, if this is all it could muster, I wouldn't expect this support to hold down here, okay, because it couldn't make it up. I wouldn't expect it. There'd be just enough damage here. Remember, we're dealing with computers too. The computers, they don't have feelings. And if they want to pile into something, they'll do it. Just like with the, what do I call it? I call it a Black Thursday with the pound. You know, they came through on illiquid period and just punched the pound. Same thing here. If it, you know, the market comes down, market comes up, fails to make a new high, I wouldn't suspect this to hold because you're going to have a lot more people selling here. And it's kind of like the bullish treatment. You know, I post at a lot of places, and a lot of people get into my face. And the more people that get into my face, I treat that as, for all the years I've been doing that, I treat that as I'm on a good thing here. I'm one of those that I'm trying to go against the herd at large turning points, like the turn in natural gas, or, you know, like after the pound got beat up, who wants to buy the pound? Well, I'd be interested in it because most of the damage, I believe, has been done now. And then you end up, say, with the natural gas people we saw on Friday, it was the managed money that was the longest of the bunch, and they got clubbed. So I listen. Going against the grain is rough, but you know, let's think this one through here a second. If something is at a 20-year low or 30-year low, your risk is going to be less, especially, you know, and that's why I like commodities, because they can only go to zero. Stocks, they have a strong tendency of going to zero. They either get bought out. You know, there was a time, you know, with General Motors, as goes General Motors goes the economy, U.S. economy. Well, General Motors went belly up. So it's basically the same principle. I know as humans, we like the group mentality, just like all those little fish. You know, that little fish boil. They're all together. They're all happy. And someone like me comes in and says, "Hey, I don't like this." Okay, I'll catch a lot of grief. Of course, I'm going to catch a lot of grief because here I am at what I would perceive as the end of a move. In theory, the most amount of individual bulls are in there, and I come in there and say, well, I just don't like it. Now, even though the indexes haven't moved per se, the individual issues have. And a lot of them. Disney, 2015 here, Apple, same thing. And the same pattern for Apple. If Apple does not crack the upper end, right now I think I'd give it into the earnings maybe 121, 125. Most of these hard spikes that I've seen, like with oh, what was it? Like Microsoft and Netflix. Okay, you have those, right? Then on the other side, you have things like IBM. And I think I'll go through the Dow 30, but they all, it doesn't make sense, right? So you're getting some of these people that, the Ackmans of the world, we don't hear much about Paulson anymore, that just are getting clubbed, okay, one way or another. Strong bouts of high volatility usually means a trend change. I mean, like Apple, the number one market cap company. Well, if you go back and look at the history of the number one market cap, they don't last at number one for very long. So once you hear, hey, Apple's the biggest company in the world, the first thing that you think of is, okay, I got to start being defensive on this. You had General Electric in there, and look at General Electric. I think General Electric, is maybe halfway back. You thought it took forever for Microsoft to get back to the highs. General Electric still trying to swim. Reminds me of Citibank. It doesn't last. And then you have like Exxon. I think Exxon would hold 2 or 3 years together, and that'd be about it. But for right now, I look at the underlines. Yes, you have your Amazons and your Microsofts and your Netflix, but on the opposite end, you have what's been going on. We'll just say biotechs. Yes, it's sector rotation, but you need to have a broad-based contribution all the way through on here. And I have to stand by what I said in June, that I just did not like the setup. After the Brexit move, I guess here we are. I'm okay. So on the New York Stock Exchange, it's back under my my warning on here, and I'll have to stand by it. And of course, I'm going to take crap, but this is the most amount of crap I've taken in a long time, but it's the same thing. I stand on my box in 2000 and 2007, and you just say, look, I'm just reading the chart. I have, I'm just giving you my opinion. I can point out that there's, like the underlying. I mean, if I didn't show the pink dots, or if people didn't look at the charts, think this one through here. We had a correction that was good for the market. We moved up, and it stalled, and they're selling off behind the scenes. And when you have people who are into indexes and they contribute, they're only going to buy those indexes anyway. They'll chase after whatever one was the best one the previous year. What do they call that? Hot hand, like in baseball. You don't know somebody's hitting 800 until after the fact. And it's the same thing here. You have some serious, failures in a lot of these issues to participate, and that's not going to help. You just can't pile into, a handful of stocks and expect this stuff to continue. But right now, like I said, I'm looking at this is basically it. I'll still give it to the bulls, considering that that people want to do something. They're waiting for something. Mostly, we're basically marking time for the election. 1968, we received Nixon, and in January, no, they barely even waited for the election to start selling, and the market fell. That was the bear market of 1970. I think the market fell 36%. So even though there may be a relief rally for whomever, whatever, ends up as the leader, it doesn't mean anything in regards to the marketplace. And if you go back and look at other marketplace changes, when the regime changed, it didn't fare so well. People come out, they change things, they bring new people in, different ideology, thinking, and so on and so forth. So, like I said, I'm treating this as just a bear market rally. If this New York Stock Exchange loses 1050 or 10,500, 400, we'll say down in here, I don't think just being around markets, this isn't going to hold. And it can be for anything the economy can pick up, but then they have to deal with interest rates. We are seeing the front end begin to roll over again, pressure the front end of rates, but they are hiding in back in the longer end. There's still some room to move there, but they are still, if the stock market goes up, the debt market comes down, and interest rates trend higher. I think that interest rates peaked right after Brexit, after that shock of Brexit. But, for right now, same thing here with the NASDAQ Composite, which was our leader of the bunch here. We'll say 5,200, set an alarm for 5,200. On the bullish side here, I can say that, we're getting a series of higher lows, short term. This is a weekly, this is a daily. Okay, so, but it's very shallow. All right, we're not getting the wide momentum moves here. This is beginning to feel the effects of the underlying issues coming out of it. So to tie this in, usually when the dollar goes down, equities go up. Okay, there will be a time though that as the dollar takes off higher, just like we saw in the 90s, the dollar went to 120 from the 80s. Okay, equities went up too, but that was part of our increase in productivity with the computer, and of course, computer is now taking all the jobs. Hey, I even bag my own groceries. I mean, so we have a structural problem overall. But when you run out and buy debt or sell debt and purchase your stock, the companies are buying their own stock and moving it higher. It just kind of defeats the purpose. But that's here nor there. They should be out investing in technology and stuff. But it's it's just a game. And unfortunately, we don't think about going to school and getting in a corporation and putting in your decades there, and there you have it. It's short term. It's you go in. It's kind of like rock bands. Rock band lasts about 5 years. That's about the end of it. Same thing here. You're coming in as a CEO. You work it through until the recession. You get forced out. The new guy comes in with the stock to beat up, and he says, "Hey, your stock's at $5. I'll make a contract around getting the stock price up," and that's how his pay is based off the stock price. Doesn't make any difference about the corporation. That's just in his contract. But when I got started in the trading in the 80s, we were still focused on earnings and things of that nature. Now it's accounting and you name it. So I'd get off my little box here. I'd like to see it go back to what it's supposed to be. I mean, it's kind of like negative interest rates and zero interest rate policy. And how do you do that? How do you fund trillions of dollars at record lows? I mean, it doesn't make sense, but you just have to go along with it. Try not to overthink it. That's why I look at the charts. But for right now, I'm gonna okay, for the bullish side, for the bullish side on the NASDAQ, I'll say it continues higher. We have earnings coming up of Apple and that so forth. So it should, I'm sure the kids are going to get frothy on the whole Apple deal here because it's moved off of the 90 area. But to me, it'd be a great opportunity to look to the short side of things. Kind of like, we have Facebook coming up, and a few others that have already moved. So if you get something like Microsoft or Netflix or whatever, those are opportunities I'd like to look at as to go against the herd. Because one, if everybody's buying it, the puts are going to be cheap. I'm not a big fan of buying options unless they are cheap, because to me, buying an option is walking up to a slot machine in high stakes, putting in $100 and pulling the handle. We all want to make it fast. We all want to make it quick. We've all had, big moves. We've all had, horrible moves. We've missed moves. Every day there's a new day, new opportunities. But the old slow but sure, kind of like Warren Buffett. Warren Buffett's not a day trader. He basically operates off of a macroeconomic cycle, and he comes to the surface when there's blood in the streets. And, so, you have a segment of people who want things to fall apart so they can go in and buy. But for right now, on the NASDAQ side, I'll leave it up to the bulls, okay, to see if they can pull something out. But if it loses 5,200, I'm going to assume that the NASDAQ will join the New York Stock Exchange and others, and probably the E-mini on S&P will finally lose 2020. And then we'll actually have something that starts up. I don't see a bear market in general, something that goes on for a year, 18 months or longer. Something short, sharp, and quick. And there's been a lot of, quick pullbacks here. Okay, this is the China, and we had another pullback coming into the beginning of the year. And to me, this is kind of like the last hurrah. Then you can see it. People are, frothy. But I'll lean right now to the bulls early in the week to see what they can do. But we'll know more by Friday to see if they can get anything through. And this may end up just like the late 90s again, where they all end up chasing after all these IPOs and stuff. And it's just a matter of time before it doesn't end. It stops, and then the rollover. We've had a pretty good run so far. We need some sort of, digestion of this, the understanding of what interest rates, higher interest rates going forward, what that'll do, et cetera, et cetera. But I'll give, I'm basically going to, for the NASDAQ bulls, I'll give them Apple, I'll give them, the earnings for this week. But it's what they do after it, You give them the tools that they need, but then they don't know what to do with it. This could actually turn out to be, besides the double top up here, you could have a head and shoulders on the NASDAQ. All right, what I'll do here is post this on the equity side of things for right now, and then I'll go back into the future so these aren't so long. All right, have yourself a good afternoon and a weekend.